Texas Instruments Inc., ticker symbol TXN, is currently trading at $201.67. It is up almost 28% over the last year and pays a massive 2.7% dividend yield. This is one of the key holdings in the Schwab US Dividend Equity ETF, otherwise known as SCHD, as you can see here. What we're going to be doing is looking at the stock, then taking it to my automated stock valuation spreadsheet to see if Texas Instruments is a buy using discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So as I said, this stock is currently trading at $201 a share. If we go to the last 5 years, it has been pretty up and down, up 50%, but from the bottom of the pandemic, up about 109% in that time. So let's get straight into it. If we put in the ticker, which is TXN, what this will do is it will load up all the latest company financial data and we can have a deeper dive. $201 a share, market cap of $184 billion, PE of 34.99, so slightly higher than the market average, which is around about 29.7. Earnings per share, $5.78, beta of about 1, meaning it's equally volatile as the market. Analysts saying it is a slight buy with a target price of $206 a share. Now, this is the dividend that people like, 2.7%, meaning you will get around about $5.45 a share. They pay about $5 billion dividend, so very high actually. Payout ratio in terms of the net income is about 90%, and the trailing 12-month free cash flow is down a bit, 1.5 billion. Usually it's around about that 6 billion, so safe in that respect, but yeah, interesting over those trailing 12 months. If you're interested in this dividend, you will need to buy the shares before the ex-dividend date, which is on the 31st of October, so the end of this month, if you're interested in those dividends. So let's get into my discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. Based on averages, this puts it at around about $100 a share. Let's have a deeper look here. I think this is due to these trailing 12 months free cash flows. Revenue is all over the place. We're expecting around about, very small growth, 1.25%. Let's see if analysts are in agreement. They're expecting, 16 and 18 billion, and over the next 5 years they're actually expecting negative growth. Very interesting. So that was about 16 and 18 million. So we will put this up a bit. We'll say 5%. That brings us slightly lower, $114 a share. Net income margins, pretty happy with this one as well, but let's take an average of these 3 years to be a bit more on the bullish side. That's about 40%. Oops, not 30. That brings us to a $117 stock. And finally, on the net income to free cash flow, obviously these trailing 12 months are a bit different. We'll take an average of these last few years, which was around about 86%. Still don't think this is going to be a buy, but puts it at around about $135 a share. So discounted free cash flow model does not really like this stock. We'll quickly have a look at the dividend discount model. You can see they've had pretty good growth of the dividend, 16%, 13%, 12%, 7%, and 5%. So we will put in, see this is that. If they can grow their last percentage, which is around about 4.8, this is putting an intrinsic value of around about $160. So we would really need growth of around about 6%, and then that would mean it is a buy at 230. But yeah, currently the growth is slowing, and it has slowed consistently, but yeah, we want to see what happens next. Before we get into the comparable company model, I just want to say, please like the video if you enjoy it, and check out my Patreon, links are in the description. We'll quickly go through the Ben Graham formula for intrinsic value. He will not like the stock due to the negative growth. We've seen this at minus 2.8%. Obviously, this will put pretty crazy numbers. Yeah, $30 a share, with a AAA bond yield of around about 4.68. This looks at earnings per share, P of non-growth company, and then the AAA bond yield. So for this to be a buy, as per the Ben Graham formula, really we're going to be expecting quite high growth, 25, 30% growth over the next few years, for it to be break even. So yeah, not a buy in Ben Graham's eyes. But finally, we are going to look at the comparable company model. This is a way of valuing stocks, looking at similar competitors of similar enterprise values and industries. Few that jump off immediately. AMD. If we type in the ticket, it will load all the latest company financials. Next, BCom. And we'll look at Intel. We can also throw Nvidia in here as kind of a more extreme case. Oh, BCom is not... What's Broadcom's ticket? Broadcom share price. Oh, Avgo. Yeah, BCom is not that, so we type in Avgo. My mistake. And we will then get an average. And what we'll be looking at here is the revenue growth rate, the EBITDA, the net income, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, and PE. So interestingly, just jumping off the bat here, compared to these competitors, the PE is a lot lower, and that's why it gives us an average of 660 looking at the PE. EV to EBITDA, about in the middle of the pack, only Intel is lower, puts it about 250. EV to revenue, middle of the pack again, Intel very low, and everything else very high. So that actually puts it an implied value of $360 a share looking at those averages. 5-year growth rate on the revenue, 2%, second lowest only to Intel. Very, very profitable. These are massive profit margins compared to the competitors. Only Broadcom comes moderately close with 10%, but with the 33% of Texas Instruments a lot higher. Price to sales, market average is around about 3. You can see these are all about 10 plus apart from Intel. Price to book, market average is around about 5.1. Once again, Broadcom Texas Instruments very similar. And price to earnings growth, Peter Lynch's formula, you can see it's in here. So interestingly, look to buy on this. Now the previous, the discount free cash flow model, Ben Graham and dividend discount model did not like it, but this looks a little bit better. Now if you were to place, we'll say Intel with Nvidia, I think this will probably make it, it brings the average up to $406 a share. This is because, look at that PEG ratio on Nvidia, less than 1. Less than 1 is undervalued, AMD and Nvidia, so I think we'll be doing videos on them. But lower PE than all of its competitors, which is a metric a lot of people look at. Right guys, thanks for watching. Please check out my Patreon if you're interested in the sheet. Give a comment if you want any stocks reviewed. Like if you haven't already, and subscribe, and I will catch you guys next time.